All right, so today we're going to go over the three-statement model. This is probably the most important part because this is where you forecast your income statement, balance sheet, and your cash flows. So we're going to get straight in. We're going to start with an overview of the financial statements, kind of what they are and their importance. This is for anyone who doesn't have an accounting background, so you can kind of catch up. We're going to talk about the forecasting methodology for everything, and then just some do's and don'ts at the end. So we're going to start out with the income statement. This is what you forecast first, and last week we talked about forecasting revenue for this. So you're going to start with your revenue, you take your expenses out, and then that'll give you your net income. That's kind of a brief overview of how the income statement works. And then the income statement is going to feed into the balance sheet. The equation for the balance sheet, assets, liabilities, and equity make the balance sheet up. So the key thing when you're doing the balance sheet and forecasting it, every transaction you make affects both sides of the balance sheet. And at the end of it, you need to make sure that your assets balance with your total liabilities and equity, or else you're going to end up with like a wrong number when you go to actually do your financial models. And then there's the statement of cash flows, which I feel like people are introduced to the least to in your basic accounting classes. So there's three different kinds of cash flows. There's operating, investing, and financing. Our operating cash flows are things like if we sell inventory and we receive cash for that, that falls under that's considered an operating cash flow. Sale of trading securities or short-term assets, they're also an operating cash flow. Investing cash flows are things where think of it as we're investing in the business. So if we buy property, plant, and equipment, that's an investing cash flow. Sale of long-term assets is an investing cash flow. And then there's our financing cash flow. And you think of this as how do we pay for operations. So issuing long-term debt, financing cash flow. When we pay dividends, that's a financing cash flow. And this statement of cash flows is important when you're forecasting because you're going to take what you have on your statement of net income, and I'm going to walk you through how to take the statement of net income and turn them into the statement of cash flows to get your ending cash balance to go on the next year for the balance sheet. So we're going to get straight into forecasting. This is a pretty cool graphic that I pulled offline, off the internet that I'll reference. So the first thing we do is we're going to forecast from our revenue, which we came up with last year, and then we're going to go down to our EBITDA. So what I did is I took this is Coca-Cola's income statement, balance sheet, and cash flows, and I took the past 4 years and I laid them out first. Then we put 2019 through 2022 estimates. And what I did is, the first thing I did is I forecast the revenue growth rate for the next year. So the year one, if we remember from last week, you take from the company guidance. The company's saying revenue's going to grow about 13% next year. So I'm going to forecast that, 13% growth. For years 2 and 3, I just did a linear regression model on the past 25 years of growth. Because if you remember, Coca-Cola is an established company, it's slower growing. So the growth rates are going to kind of cluster around that kind of line of best fit. It's not going to be anything too crazy. And then year 4, I had them grow at the rate of the economy, or I used the terminal growth rate. And all I did for that is I just took the past 40 years of GDP data, or 30 years, and then just got the average growth rate. And that's year 4. So once I have that, what I do is I kind of take a block and I take my assumptions and I'm going to put them over here. So for 2019 to 2022, what I did is if you see in the cell, I linked them over to the other spreadsheet. So I've got the 13%, the -2, the -3. And then what I do is I go straight across first and I just multiply each one by the growth rate to get all of them. Now the next thing we have to do is we have to get the cost of revenue and the other operating expenses. Now the way that you typically do these is they're a percentage of sales. So the formula for it, if I look in 2018, all I do is I take the cost of goods sold, the cost of revenue, divided by revenue to get the percentage. And that's why I have 4 years of back data. Because all I did is I took 4 years of cost of revenue, the percentage, and then took the average, and I use that for every year afterwards. So 2019 is the average of the past 4 years, 2020 is the average of the past 4 years, and so on. And I'll share this with you so you can go through afterwards and kind of look through the equations that go into the sheet. Same thing with other operating expenses. That's also just a percentage of revenue. Usually, and especially with a company like this, when you do it, or Coca-Cola, most consumer staples, or older, mature companies, it's typically going to be about the same, and it's not going to deviate from the average of the past 4 years very much at all. When you're looking at other high-growth companies, there's other ways you can forecast it. You might want to use some kind of regression analysis to figure out how much smaller it's going to get. Or the other thing you'll do is you'll look at the company guidance and say, well, it's dropping by 5% over the next few years in their PowerPoints. And you'll kind of use that to kind of taper it off. So now that I have those two things, I take revenue minus the cost of revenue to get gross profit. I'm going to take out the other operating expenses, and I forecasted my way down to EBITDA. Now, in all of those buckets, when you export these from Bloomberg, it's going to show all the items that make up cost of revenue. You just want that big orange one at the top that's cost of revenue. There's no sense in trying to forecast all those little things that make it up. It's easier to just lump it together for these purposes. So now that we forecasted the EBITDA, the next thing we do is we do our accounts receivables, inventory, and payables. So we're going to head over to the balance sheet for that one. And much like with the cost of revenue and then the other operating expenses, these are also, for a company like this, typically a percentage of sales. It's going to hold a certain percentage of its revenue in inventory. You think of the reason receivables is a percentage of revenue is because typically you're going to sell on credit a lot. You'll have a certain percentage of that that's going to be tied up in accounts receivable, and payables for the purchase of inventory. Typically it's a similar percentage of revenue you have tied up in payables outstanding. So once again, if you look over here, I kind of separated the assumptions out, and this is the best practice for this is to separate these out into a different block over here, so you can see it, and then use an equation to multiply them in. That way, if you see anything weird or kind of funny, you can adjust your averages or your forecasts for it. So receivables, same thing, about 10% of revenue over the past 5 years. So I went and plugged that in. Inventory was 7.5. Payables is 25% of revenue. So I'm going to start kind of inputting these items in. So I'm going to multiply 2019's revenue for receivables by the percentage of revenue that receivables is. So every year you're going to take the revenue at the top, multiply it by the percentage, and that'll give you how much revenue you have on your balance sheet. So now that we have those items, we forecast property, plant, and equipment. There's a couple ways to do this. The way that I did it was as a percentage of sales, but when you have more time and you're actually pitching something, or for those of you doing the CFA pitch, when you learn more about the business, you're going to be able to figure out at what rate they want to acquire net property, plant, and equipment, and what rate they depreciate it at, and then you're going to actually do a separate forecast for property, plant, and equipment, and then plug it into here. But for most pitches, a percentage of revenue will get you close enough where your valuation model won't be horribly off. So this is, again, another percentage of revenue. Okay, I found it was 27% of revenue there, net property, plant, and equipment. And then from there, you take a look at their capital structure to figure out how much debt they have in their target capital structure. Typically, the company will issue statements on it. For this, what I did and what people generally do is they take the long-term debt, they leave that the same. Other long-term liabilities, they'll typically do a percentage of sales as, because that does tend to fluctuate. And then when you look at share capital and additional paid-in capital, you don't know when they're going to issue equity. Don't even bother, just keep that the same. Treasury stock, the same thing with treasury stock. I don't know when they're going to do stock buybacks or what their plan is, and they don't tell me far ahead or ahead enough. So I'm going to leave treasury stock about the same. And then from there we have all the information to finish the income statement. Now this is where it can get a little confusing. So we forecasted property, plant, and equipment. Depreciation is a percentage of property, plant, and equipment. So what I did is I take the depreciation from 2018 and, well, this is a bad example because I just kind of plugged it in to get the right number, but to get all these numbers out here, I figured out, like in 2018, I took the total depreciation expense divided by property, plant, and equipment to figure out that it's about 11%. And I did that for all 4 years and came up with a 4-year average. And it's important when you do this to look at it. If you see numbers that are outliers, don't include those in your average because that means their depreciation schedule might be double declining, which means it's actually going to get lower. So you don't want to have like a crazy high number in there that's making your depreciation expense go up year over year. Because typically that doesn't happen unless they're buying a ton of new property, plant, and equipment. So it's important to look at. And then, so all these are is just an average of the past. I did the past 2 years because they were closer. So that's like what percent of property, plant, and equipment depreciation is. And then for 2019, for 2019's depreciation, I took the forecasted property, plant, and equipment times the percentage of depreciation to get the expense, and then subtract them to get earnings before interest and taxes. And then interest expense works the same way as depreciation, where it's a percentage of long-term and short-term debt outstanding. So their interest expense as a percentage of debt is about 0.4% on average. It's usually pretty low because they issue debt at fairly low rates. If you remember from last week, the cost of debt's like 1%. So you shouldn't have like a really high number sitting in depreciation. So once again, average that, and then we take the debt that we forecasted, and that's how we get depreciation for the next week, or for the next line. Then we'll subtract that out to get earnings before taxes, and then next we'll do the tax expense. The way that I did it is I just took it straight from Bloomberg. I either took it straight from Bloomberg or their 10K, I can't remember which, but they'll publish about what their tax rate is. On every company you do in 2017, if you feel like you want to take an average of tax rates, don't use 2017. When they change the tax codes, they have these things called deferred tax assets where they're allowed to pay their taxes after the fact. When they lower the tax rate, they have to revalue these assets, and when they're worth less, they have to just take the hit in taxes immediately. So most companies like Coke have an 83% tax rate. But especially if you have international subsidiaries, you have like a 70, 80, 90, I think in some cases over 100% tax rate from this. So just don't use that in your average if you're going to do that. I mean, you don't even want 2016 or 15 because the tax laws were different, so you could just use 2018 as the tax rate if you wanted to do it that way. For those of you doing the CFA pitch with Hamilton Beach, if you ask me, I can show you how to actually calculate what its tax rate is going to be in the next year. But for our purposes, usually Bloomberg or the 10K is probably the best place to go. After that, I've got net income. And then I also included dividends on the bottom because if you remember from accounting, to get to retained earnings, it's net income minus dividends, and then we'll add that to retained earnings on the balance sheet. So I took the dividends, and their dividend growth rate is it's supposed to be like 0 this year, and then about 3% after that is what they said. So I just grew out the total dividends. So now that we have the income statement done, we need to finish filling out the rest of the balance sheet. All that's left that you need the income statement for in the balance sheet is to find retained earnings. So if you take the net income from the year that I'll show you for 2019 in retained earnings, what I have is I have last year's retained earnings, I add this year's net income, and I subtract the total dividends they're going to pay this year. And it's going to be like a very small addition usually. And then the next thing we need to do is we have to figure out cash. So to figure out cash, what I did is you take the statement of cash flows from last year, and there's only a few items that you can forecast and that you need to forecast to figure out the net change in cash. So in 2019, you're going to add I wrote the whole thing out, but everything with a zero, you don't have to forecast if it's not on one of the other statements. So their net income, you're going to take their net income, plug that into operating cash flow. Depreciation, you're going to plug that in. The change in non-cash working capital, which basically means all the current assets minus current liabilities, and you exclude cash and current assets so you don't create a loop in your formula in Excel. And then you're going to take and that's going to give you cash from operating activities. And the formula for it is net income plus depreciation minus the change in non-cash working capital. That's the formula, and it's all on here, and you can look through this sheet when you need to do this for real. Okay, then to figure out investing, we take the change in property, plant, and equipment. So how much did we grow from last year? So 9 million. Other investing activities. So for the other investing activities, you're going to take short-term investments on the asset side. How much did those grow from year over year? And then the cash from investing activities is just the sum of those. So for financing, dividends paid, that's a subtraction from cash, so I put that in negative. Cash from debt. So what you do is you will subtract the short-term debt, or the difference in short-term debt. They paid a bunch of it off, that means they lost cash paying off their short-term debt. And then add up all these, that's the financing activities. And so like this stuff with zero, like cash from equity, if they tell you that they're going to be issuing equity, or like in their 10K, like we're going to issue however many million of equity, you're going to put just positive, 100 million in equity that they issue, because that's cash they're going to get from the issuance. Discontinuing operations, typically don't worry about that when you do it. That's also something that's kind of hard to predict, because you don't know when they're going to sell parts of their business or close down a factory or whatever, and what the change in cash is going to be. And then the net change in cash at the end of it is you're going to add up the operating, investing, and financing cash flows. And then you'll take that negative $2 billion and you will go up to the balance sheet in cash, or maybe the negative $2 billion, and you'll just add the change in cash to last year's cash balance. And now your balance sheet's almost done. Now the secret to making the balance sheet balance is this other equity account here. So what you have to do is, in order to prevent a formula loop, assets, everything is calculated as either it's a percentage of revenue, and then we add them up to get like total short-term, total long-term assets, and the total assets. What we do for liabilities and equity, for liabilities we just go down and everything's a percentage of revenue, and we're just going to add all of that up. And when we get down to equity, what we do is we have this tab called other equity. So we set total liabilities and equity. The formula is it just equals the total assets. And then to make this balance in the other equity tab, you take the total liabilities and equity, you subtract total liabilities, you subtract retained earnings, and then you subtract share capital and additional paid capital, and then you add treasury stock back in. The reason you add treasury stock back in is because while it's on the right side of the balance sheet, it holds a normal debit balance. So it's actually subtracting from retained earnings. So in pretty much any other year, if you look at their balance sheet on Bloomberg, it'll say treasury stock is a minus to total equity. So you have to make sure you add it when you do this formula. And then it's called other equity. You can also call it change in other comprehensive income or something like that, whatever sounds good, or whatever item that you have on the balance sheet. And that'll do it. So that's it for 1 year. Basically for every year, it's kind of the same loop. You're going to go down halfway down the income statement, use a percentage of revenue to solve for everything else. Then you're going to finish the income statement, and then you're going to do the dividends to get retained earnings, and then you're going to go to cash flow to find the change in cash, and then just balance it. So it's a pretty simple model. It just it's really confusing, and it's very time consuming. Like this, I think this one took like 3.5 hours to do. It just takes a while. But once you have all this forecasted out, you can use this on just about, you can use pretty much any financial model now, because now that you have everything forecasted, it's just pretty much plugging numbers in. Yeah.
So for the 4 years, could you just drag formulas across?
Yeah, once you get like the first year done, so once 2019's done, you can just drag everything across after that. It's just getting 2019 set up in the correct order. Once that's set up, you can just drag it all straight across and it'll work. Or the other way to drag the formulas is you can do each one of those items and then drag the formula across each time you do it and then go in order. That's what I did for this. Yeah, so that's pretty much it for this. If there's any more questions, or I know it's a lot in a really short amount of time. Yeah, it seems, so what I'll do is like, you can come up and you can share this with yourself, and then I'll also have the video uploaded so you can hear me like just kind of, if you want to slow it down and just listen to me walk you through it again. But other than that, we're pretty much done.